Hey, this is Chris, and today I'm going to be discussing some of the key differences between investing into emerging markets versus developed markets. Now, in the StockSpot portfolios, we have an allocation to both of these different types of global shares. Emerging markets in Australia, you can get access to via a few different ETFs. There's a BlackRock ETF and a Vanguard ETF. We ultimately recommend the BlackRock ETF, but they're both pretty good. And then developed markets, there's probably a bit more choice. We invest in the Global 100 ETF that has a large exposure to the US and then some of the other major global economies. But there's also pure US ETFs or pure Europe ETFs that can give you a developed market exposure as well. So I'm going to be talking about some of the differences between these ETFs, why we have them both in our portfolios, but also the sorts of environments one may perform better than the other in, and ultimately why that's beneficial to you as an investor. So first of all, what are the underlying holdings in these ETFs and how do they differ? Now, developed markets, as I've just mentioned, typically have a large exposure to the US because it's the largest developed market in the world in terms of the market capitalization of all the underlying holdings. So in our Global 100 ETF, there's about a 70% exposure to the US share market, to US domiciled companies. This doesn't mean they only operate in the US. A lot of US companies have global operations, but they're just listed on the US share market. And as well as the US, other countries like Switzerland, Japan, Germany, and the UK have relatively large exposures as well in the developed market ETFs, including the Global 100 ETF that we recommend to clients. Now, this differs a lot to the developed market ETFs, or to the emerging market ETFs rather, that are out there. So emerging market ETFs tend to have a large exposure to countries like China, Taiwan, India, South Korea, and up until recently, a lot of them had some exposure to Russia, although this has now been removed from most of the global emerging markets ETFs. So obviously very different country exposures. Developed markets typically, they're growing at a slower rate, whereas emerging markets are higher growth economies, but they also have higher levels of volatility in terms of their economic growth, but also their countries more generally. And so as an investor in emerging markets, you tend to see more volatility in that investment. So that's the country differences. In terms of sector differences, again, there are subtle differences between the emerging and developed market ETFs in terms of the underlying holdings. The global developed markets ETFs tend to have high exposure to technology. So in the US market, a lot of the big companies are tech companies, as well as healthcare and consumer staples. Consumer staples is like the equivalents of grocery stores. On the other hand, the developing or the emerging markets ETFs have a higher exposure to financials, so banks. Again, technology weights pretty high, and consumer discretionary is the other big sector there. So you do get a slightly different sector mix, whether you're investing in global developed or emerging markets. And that also translates into quite different performance. So what we've seen throughout history is that emerging markets and developed markets tend to take the lead in terms of performance at different parts of the global economic cycle. So back in the 1980s, when inflation was high, and a lot of these emerging markets were really doing very well, emerging markets had a fantastic decade and developed markets didn't do very well. Then in the 90s, it actually went the other way around. A lot of the developed markets did very well. Emerging markets didn't do too well. There tends to be a to and froing of whether emerging markets or developed markets are doing well. And there are some underlying reasons for this. So one of them is that a period of lower inflation tends to support developed markets. There tends to be a lot of technology businesses, particularly at the moment in the US market and developed markets, where low inflation and low interest rates really benefits these sectors. It really benefits high growth companies, whereas emerging markets tend to perform better in periods of higher inflation. And the reason for this is a fewfold. So first of all, higher inflation often goes hand in hand with higher commodity prices. And a lot of the emerging markets are actually quite exposed to commodity prices. The likes of Brazil through iron ore, or Saudi Arabia through oil. If the prices of these commodities are doing well, generally these economies and stock markets are doing well as well. As well as that, as commodity prices rise, the trade balances of these emerging markets improve as well, which helps the emerging market share markets. And more than that, emerging markets tend to do well in periods where low PE or price to earnings ratio shares do well. And the reason for this is that when inflation and interest rates are higher, PE ratios, stocks that have lower PE ratios tend to do better because investors are prepared to pay less for future earnings and put higher value on today's earnings. And so they don't really value the growth in a lot of the higher growth stocks in the developed market ETFs. So this is one of the reasons why we at StockSpot have an allocation to both developed and emerging market stocks, because in different economic environments, you're going to see them perform well or poorly. So over the last 10 years, 2010 to 2020, it was definitely a great period for developed market shares. You know, technology was really the leading sector in the world, and US had a big exposure to technology shares. That seems to have changed tune a little bit, at least over the last few months. The start of 2022, technology shares have performed pretty poorly. Now, as it happens, emerging markets haven't done a lot better recently. In fact, because of the drag of the Chinese share market, emerging markets have done pretty poorly. But there are some emerging markets that have started to do really well, particularly the South American emerging markets, markets like Saudi Arabia due to their oil exposure, in Brazil. And so we are seeing some of these emerging markets start to lead the market higher. And really, from a diversification perspective, we think investors should want an exposure to both developed and emerging markets, because there are going to be periods of time where one does better, periods of time where the other does better. It's very hard to predict whether we're going to be in a period where one or the other does well. And so we like to have an exposure to all of them for our clients. And so you'll always have exposure to some global companies doing well. And ultimately, your risk is spread across a whole bunch of different countries, different sectors and different companies. And so you're really well diversified and your risk is spread out. And this is the reason why we recommend both developed and emerging market shares to our clients. Even if there's periods of them not performing fantastically, we think you should stick with it. Keep an exposure to both in your portfolio. And as we do for clients, automatically rebalance when one weight goes out of kilter with the rest of your portfolio to keep your portfolio balanced.